Okay, so now in chapter 2, we're going to move on. Now we're going to look at you know, balance sheet, income statements. The first thing we're going to look at is the balance sheet. Okay, the balance sheet is a snapshot of our company at a specific point in time. Okay, you can see here we have our assets listed on the left side of our balance sheet. On the right side of our balance sheet, we have our liabilities. Okay, those are on both sides of the balance sheet. We list them in order of liquidity. So the most liquid assets and most liquid liabilities are at the top, and we drop down to our least liquid assets and liabilities. Okay, when we talk about current assets, we're talking about things cash, inventory, accounts receivable. Um, Current liabilities, accounts payable, those are to suppliers, and notes payable, banks, generally things that are going to be converted to cash within 12-month period. Okay. Um, Now you can see that when we talk about our net working capital there, it's just our current assets, the cash, inventory, accounts receivable minus our current assets, or current liabilities, I'm sorry, the accounts payable, notes payable. That gives us our net working capital. That's the money that we're dealing with on a day-to-day basis. Okay. As we said, things are listed in order of liquidity. The thing I want you to understand about liquidity has two aspects to it: time and value. Okay. Cash we list first because it's already cash, it's liquid, we don't have to do anything to it. Okay, inventory, depending on what our inventory is, it can be a very liquid product or asset in itself. You think of a grocery store. If you go to the produce section, you want your vegetables, bright, colorful, crisp, all of that. So that inventory has to turn over rather quickly, and that's why grocery stores get trucks 2 or 3 times a week, right? Versus something like a Tractor Supply, um, where they aren't selling tractors. They aren't turning their tractor inventory over every 2 or 3 weeks. If they were, boy, they'd be rock stars. Maybe they're turning it over every few months or once a year. Okay, so understand that liquidity, any asset technically could be made liquid. What happens to that when we do is we lose value. Okay, so an example of that is, let's say, just use ASU as an example, the College of Business. This is an asset to the school, and if they wanted to liquidate it, they could put it on the market. Now, given where it's at and things, some hotel company would come in and buy it in a heartbeat, probably, but the price might be an issue. But let's say hey, if they drop the price down or the value down from, who knows, let's just throw a number out there, say it was $5 million, now they drop it to $500,000, somebody's going to buy that up quick. Okay, so they were able to get cash quickly, but in order to do that they lost value. So that's just an example, hopefully a decent one, that you understand what that liquidity has two aspects to it: time and value. Okay. The other thing I want you to see when you're looking at this, if you look and think about it, we talked about capital budget and capital structure earlier, right? The left side of our balance sheet is a representation of our capital budget. What are those things that we invested in? We talked about a restaurant, right? Did we buy or did we rent? That's going to affect the value of those assets on the left side of our balance sheet. If you look at the other side, okay, that gets into the capital structure. So you can see how those decisions that we made in chapter 1 or early on in our business process are starting to come to fruition. Here's our capital structure. Where did we borrow money? Remember, money comes from debt or equity, stockholders there, so debt or equity. So you can start seeing where those decisions are starting to come into play. Okay. The other thing that you have to understand here with the balance sheet, our assets and liabilities and the equity are listed at book value. Now, there's a difference between market and book value. Okay, remember, book value is technically, book value is the historical cost minus our depreciation, or how much of the asset have we used up, right? Market value is what is somebody willing to pay for the asset. Book value and market value can be very different. If you think of the example we just used with the College of Business as far as liquidity, the book value of this building of the College of Business, it might be whatever we said, $5 million, right? But when it comes to market value, that can go one of two ways. We could look at, wow, the location, it's in town, there's not much room to spread out. ASU has the property around it, so maybe that's going to drive the market value down. Then again, being the fact that it's so close to campus, it is in the heart of downtown, that might drive the market value up, because if you bought it and converted it to apartments, then you wouldn't have, the students don't have to worry about walking anywhere, or driving anywhere, they could walk everywhere they wanted to go, okay? So market value is the price somebody's actually willing to pay. And the thing is, in finance, what we're worried about, what we focus on more, is market value versus book value. It doesn't matter what I'm carrying it on my balance sheet for. What matters is, what is somebody willing to pay me for that asset, okay? So understand that and remember that. In finance, we're worried about market value, what somebody's actually willing to pay for that item, okay? All right, we'll talk more about that a little bit later on, but that's what you need to know about balance sheets, and we'll talk about income statements next.